Welcome everyone. Our topic for today is assets. By the way, my name is Lord Stanley Gutierrez. You can now follow and subscribe to our channel for more topics about bookkeeping and accounting. Welcome guys to our first presentation. Our introduction in asset is a resource with economic value that an individual, corporation, or country owns or controls with the expectation that it will provide a future benefit. Assets are reported on the company's balance sheet. They're classified as current, fixed, financial, and intangible. They are bought or created to increase a firm's value or benefit that firm's operation. An asset can be thought of as something that in the future can generate cash flow, reduce expenses, or improve sales, regardless of whether it's manufacturing equipment or patent. So let's get started. Here are the types of current assets. We have cash, cash equivalents, short-term investments, notes receivable, accounts receivable, inventory, and prepaid expenses. Types of non-current assets. We have long-term investments, property, plant and equipment, accumulated depreciation, and intangible assets. Are you ready? So let's discuss about current assets. Current assets are the cash and other assets that are expected to be converted to cash within a year. Compare with fixed assets. Cash is a part of the current assets. Cash is any medium of exchange that a bank will accept for deposit at face value. It includes coins, currency, checks, money orders, bank deposits, and drops. Next is cash equivalent. These are short-term, highly liquid investments that are readily convertible to known amounts of cash and which are subject to an insignificant risk of changes in value. Short-term investments. Short-term investments. Investments which are readily marketable and represent temporary investments of funds available for current operations and are intended to meet working capital requirements. Notes receivable. A note receivable is a written pledge that the customer will pay the business a fixed amount of money on a certain date. Accounts receivable. These are claims against customers arising from sale of services or goods on credit. This type of receivable offers less security than a promissory note. Inventory. These are assets which are held for sale in the ordinary course of business, in the process of production for such sake, in the form of materials or supplies to be consumed in the production process or in rendering of services. Prepaid expenses. These are expenses paid for by the business in advance. It is an asset because the business avoids having to pay cash in the future for a specific expense. This includes insurance and rent. These prepaid up items represent future economic benefits, assets, until the time these start to contribute to the earning process. These then become expenses. Next, we will proceed to the non-current asset. Let's discuss about non-current assets. Non-current assets are company long-term investments where the full value will not be realized within the accounting year. In current assets, these are the short-term investments, and the non-current assets are company long-term investments where the value will not be realized within the accounting year. First, in types of non-current assets, we have long-term investments. IASC, also called International Accounting Standards Number 25, defines investment as an asset held by an enterprise for the accretion of wealth through capital distribution such as interest, royalties, dividends, and rentals. For capital appreciation or for other benefits to the investing enterprise, such as those obtained through trading relationships, investments are classified as long-term when they are intended to be held for an extended. Property, plant, and equipment, also called PPE. These are tangible assets that are held by an enterprise for use in the production or supply of goods or services, or for rental to others, or for administrative purposes, and which are expected to be used during more than one period. Included are such items as land, building, machinery, and equipment, furniture and fixtures, motor vehicles, and equipment. Accumulated depreciation defines investments as an asset held by an enterprise for the creation of wealth through capital distribution. Next is accumulated depreciation.